Hello and welcome to our latest Insider interview. Today I have with me Simon Holmes, who is fund manager of the BMO Sustainable Universal MAP range. Simon, thank you for joining me today.
Thank you for having me.
The Cautious, Balanced and Growth Fund were all launched in December 2019. How would you assess performance since then?
Yes, so in general, we're pretty happy with performance. If you look at each of those funds and its return per annum, so the Cautious has returned 5% per annum, Balance has returned 7% per annum, and Growth has returned 8.2% per annum. So that's over that period, but turned into sort of per annum numbers. And actually, the Cautious is in the second quartile of its sector, which can include much riskier funds. Balanced and Growth are both in the top quartile. So we're pretty happy with that overall. If you look at the breakdown by year, so 2019, they were launched right at the end. So the first full year, it would be 2020. And the funds all did really well in 2020 through that COVID recession and out again. So they were absolutely all top of their sectors there. 2021 was also a good year. The funds were performed sort of in line with market, with equities rallying. That obviously was very helpful. The main challenge we've had has been the beginning of this year. And these sorts of funds, sustainable funds, they do have a bit of a bias towards growth and quality. And the start of this year has been all about a rotation from growth and quality and towards value or yield and other things. And so that has weighed on performance a bit. I would say that comparing us against traditional funds or non-sustainable funds, we'd be behind. But when you look at us compared to other sustainable strategies, we're definitely doing well there compared to peers. So all taken together, we're really happy with how things are going.
You mentioned the fund has a growth bias. So what's your views on the market rotation that's been taking place since the start of this year?
Yeah, so it's absolutely right that nearly all sustainable funds will have something of a growth and quality bias. And if you think about why this is, when I was saying earlier, we are excluding certain types of companies. So we're excluding tobacco, we're excluding fossil fuels, and those both have either a sort of yieldy bias or a cyclical bias. And then we're investing in companies that are very focused on technology and solutions of all different types. And for us as managers, we also want high quality companies in there. So that is something you'll typically see. And it has been a headwind in the market, has been focusing on other things and rotating away. So the question for us is, what do we think going forward? Now, one thing we've had already done is we'd had a larger allocation to the UK than in the past. And the UK has a bit more of a value tilt, even on the sustainable side. So that helped to some extent. Looking ahead, I think it's more balanced now. So whilst we've had that move, I don't think we're going to continue to get that level of move as much. Quite a lot is now in the price. The market is looking at much higher interest rates and inflation, so it sort of knows what's there. But at the same time, I don't think we're going to go back to a world which is purely just growth always winning, which is what we saw for several years. So we expect a more balanced future, if you like. And what we want to do and what we have been doing is increasing some of those names which are still sustainable, but which have a bit more of a value or a yieldy bias. We've also been working on a new strategy, if you like, to add in, which itself, it's still a global sustainable strategy, but it looks much more for some income. And that often will help in this sort of an environment. And again, allocating we had some high levels of cash, we've allocated some of that back to some equity sectors as well to just add a bit more of a bias there. Those three things taken together, we think will put the fund in a good position, no matter what we see over coming years.
As you just mentioned, the UK is well represented in the free funds. Is that a market you've been adding to over the past couple of months?
Well, certainly over the last half a year or so, we've been adding to the UK. We saw better valuations there, but also when the UK went into COVID, it got badly hit. But as we saw actually good approach and policy within the UK towards COVID, we expected a very good bounce out of that. And that was something that we did in 2021 and have continued to do. So that addition of more UK names has really helped, particularly in the face of the rotation we've been seeing recently. Now, again, there are certain names that we like there. So something that we've added recently, to come back to the last couple of months, is Tate & Lyle. Tate & Lyle, most people think, oh, that's a sort of sugar and syrups company. How can that be sustainable? But they've really changed their business model around. They're much more focused these days on the nutrition part of food and health benefits and being able to provide that sort of thing. So that's a name we've added. It had a good valuation. Another name that we've added recently in the UK is Life Sciences REIT, which is it's a property or real estate company, but it's focused absolutely sort of narrowly on providing property for life sciences, sort of biotechnology and research and that sort of thing, and mainly in the so-called Golden Triangle of Oxford, Cambridge and London. That name came fairly recently towards the end of last year at a good valuation, so we added that as well. So we think there are good opportunities in the UK for a sustainable fund, but you've got to look at the right name and get the right valuation.
Outside of the UK, have there been any major changes to the portfolio over the past couple of months?
There have been some changes. I mean, we typically are not a very high turnover strategy because we like to find names we really like at good valuations, and then we can hold them for a good time. But there's always going to be things that are changed around. So one of the global names that we've sold recently is Shopify. Now, Shopify, their business model is about enabling all sorts of small companies and individuals almost to set up their own company. And so that is a good thing from the point of view of sort of building global prosperity and access and so on. But the thing that we felt with Shopify is they're in a competitive sector. And as we go and stay in this sort of inflationary environment, pricing power is going to be really important. And in the sector they're in order to maintain their product and their margins, they would really need to invest more. So we weren't seeing the level of investment that we felt we should see. So that's a name that we've reduced. Another name that we've reduced in the UK is Genus. So that's a sort of agricultural biotech company. But some of their earnings are coming from China. We were uncomfortable with how the outlook was for China, worried about revenues there. So that's a name that, we felt that they were sort of overvalued given that worry we had. So that's a name that we've reduced. There's been some other names that we've added. There's Norton LifeLock, which is a sort of digital security company. That obviously means everybody can access the internet and all sorts of other aspects of digital economy much more safely. We saw that at a good valuation. I mentioned Tate & Lyle. There's also PodPoint, which is a company that provides electric vehicle charging points. So clearly that's aligned with sustainability, but also we saw that as being at an attractive valuation.
You touched on pricing power. So is the current high levels of inflation and increases in interest rates influencing your investment decisions?
Yes, and it has been for some time. So right at the beginning of the CMAP's range, its life, we had a reasonable allocation to government bonds, and that was very helpful because as we went into that COVID-induced recession, that really helped bolster returns in the portfolio, given what equities were doing. But at the very depths of that period, yields became so low on government bonds that we felt there was really no more value to be had. Their use as a diversifier was going to reduce. So at that point, we reduced our government bond holdings and then we increased our cash levels. And what we were waiting to see is whether yields move higher. We thought they would. We were worried about inflation and interest rates. And over the last year, we've certainly seen a big move higher in yields. So I'm not saying right now there's lots of value in government bonds, but we are at least thinking that there is some benefit to owning them. We've started to increase back our allocation. If there were to be a sudden recession, not that that's what we expect, one would need some government bonds. So we've started to increase government bonds while still being less than we might normally have in a neutral environment. And if yields continue to move higher, we will add back some more. Again, looking at the equity side, it's made us more focused on those companies with pricing power. And so we've been looking through the portfolio, making sure that the names we've got really do stack up in that environment. And as I was saying, we've made a couple of adjustments. You really don't want a company that's not able to pass on. And you often want to see that they're investing as well, because that's partly what enables their product to continue to win market share against competitors. And that enables them to maintain pricing power and margins.
The cautious fund has around 13% in cash at the end of February. Is it that cash weighting that you've been reducing to purchase government bonds?
Yes, so 13% is a high allocation to cash, even for the cautious fund. And like I'd said, the reason we got to that point is we just didn't want to have to allocate that to government bonds when yields were so low. But now that we've had some significant moves in those markets, we've taken some of that cash and we've allocated it back to government bonds. We've also taken some of that cash, a small amount, and allocated that to a bit more equity. Partly that's thinking about, well, inflation, and assuming we've got the right names, then equity really does give you perhaps a better chance of maintaining real value in the face of that inflation. And we believe in the names that we own. So we allocated a bit there, not too much. And that means taking those two decisions together, we've come from that 13% down to more around at the moment, the 6% level. And we anticipate that over time that will continue to go on as we see better value elsewhere.
And finally, a question that we ask all fund managers that we interview: do you have skin in the game?
I do. I'm a holder of the Sustainable Universal Growth Fund, which is the riskier end of the three funds we've been talking about.
Simon, thank you very much for your time today.
Thanks for having me.
That's all we have time for today. Please do check out our YouTube channel for the rest of our Insider Interviews video series, and please do give us a like and subscribe. See you again next time.